All right. This is video two, course three of the cash flow management and paying ourselves series of courses for the school community of private practice owners. I appreciate you tuning in here. And this is a big one because we're learning how to pay ourselves. And really, that's the purpose of business, isn't it? So in this course, we're really going, or in this video, we're really going to talk about sort of the different ways to pay ourselves, why we should pay ourselves, how we should pay ourselves, and what we should be accounting for as we pay ourselves. And so hopefully through this, we will learn the proper amount that we could pay ourselves and what we need to leave in the business for taxes, expenses, all that other jazz. So thanks for joining me. Let's go. All right, here we go. This is the Paying Yourself course in video, or video three, course two within the school community of private practice owners. I appreciate you being here. Now let's get into what we're going to talk about. First, we're going to dig into sort of the paying yourself, what it means, what the different types, and why it matters. The different ways that you can pay yourself and what it means for taxes, factors to consider when paying yourself, because you are a business owner. It's not just you, and even when it's just a solo practice, it's not just you that you have to account for, but also your clients, both ones that are there and coming, as well as your long-term and short-term goals for the practice. And then strategies to ensure you're paid regularly. We'll dig into a few of those, and then just want to make sure that that pay matches the goals. And we'll talk about how to think about that so you're not overpaying yourself or underpaying yourself in many ways. Real quick, before we um, move forward, make sure to sign up for that newsletter, thinkingcapfinancial.com/newsletter. I'm on YouTube at Thinking Solo. You can find me on LinkedIn, my name, Ryan DeRusso. And of course, share this course because it's the only way we're going to grow this and grow this community. And the more that people see these courses and go and then see the community that's involved, the more that are going to sign up and the more robust that community becomes and the more help you can gain from that process. So make sure to do so. And then of course, my suggestion is always watch 2 times speed. I sound better that way. And then you can always go back. All right, now we're going to talk about paying yourself. So this is the key to long-term practice success. And why do I say that? Because we're not in a business just to get by. Instead, we want to be building income and wealth for ourselves. Because if we're not, then we're going to really disgruntled in the practice and eventually quit, burn out, because we're not covering our needs, we're not covering our wants, and we're not seeing the growth that we feel we deserve as qualified therapists that are highly educated and really good at their job. And if you're not paying yourself, then you're never going to feel that worth. And it's important to understand the different types and ways you are paid, but it's also important to actually do it. And so let's get into sort of how to do so. So there's many different types of ways that you get paid both in the personal and business. So salary is kind of what you imagine. It's a W-2 employee gets a salary for the work that they involve. As a practice owner, you probably pay yourself a certain amount, and you could consider that salary in many ways. And depending on how your business is structured, it will be taxed differently based on that. Owner's draw is an example where you are both the business owner in the practice and also the employee. And so if you have certain business designs, you are the business owner or the employee where you get a salary, and then you're the business owner. And when you're pulling from that side of for your investment in the practice, it's called owner's draw. And so it creates two different tax scenarios, and we'll talk a little bit more about that when we talk about S corps, because that's where it becomes very common. Revenues is what your clients give you or what the insurance panels send you for payment for the session. So your gross revenues is everything that they have given you, and then net revenues is sort of minus all the expenses involved. So if you have a session that's $200 a session and they pay you, that's $200 in revenues, but there's expenses, say $40 a session. So now you're only got down to 160. That would be net revenues. And then profits is after taxes and all the expenses have been accounted for. And those are after tax profits that either are kept in the business or given to you on the personal side. And then you need to realize that you need both accounts. You need a business account that is managing, those revenues and profits, and you need a personal account that is collecting that salary and or owner's draw. So you are keeping things separate, and one, how much to pay yourself, but also be able to track things correctly as they're going back and forth. So part of the reason I was talking about the salary versus owner's draw is because depending on the way you've structured your business, you're going to be taxed differently. So one, you have an S corp, or you have an LLC, or you could have nothing, which is kind of what a sole proprietorship is, and how your tax is going to be very different, and how you pay yourself is going to be very different. Sole proprietorship and single person LLCs are going to be very similar in that everything you make as revenues is going to eventually be taxed to your personal side. It's called a flow through entity, and they're taxed exactly the same. You are paying a self-employment tax on most of that money, and there's not much you can do to kind of maneuver around that self-employment tax, which is Social Security and Medicare, which I'll talk a little bit more about in a second. And there's really no difference between owner's draw and salary at that point. Now, if you decide you opt into an S corp at some point, what you can do is separate yourself. So now you are part employee and part business owner. As the employee, you can collect a salary, and that salary you have to pay self-employment tax or Social Security and Medicare tax on, which that is 15.3%. And then the amount that you take as an owner's draw is not taxed for Social Security and Medicare. It's taxed as regular income, so you still have to pay taxes on it. It just doesn't receive that Social Security and Medicare tax hit. So you can kind of reduce your overall tax exposure once you've reached a certain size that makes an S corp useful. And we'll talk a little bit more about that in a second. Really, when you're looking at not only how you pay yourself, but like which business structure to use and whatnot, really what you need to do is balance your business needs with your personal needs, because we need a certain amount of money on the personal side, and we need a certain amount of money in the practice to continue to grow and expand and invest in things and whatnot. And knowing what you need for both sides is going to be really important, because we want to create a balance here. We don't want to overpay ourselves here and the business just kind of wilts because we're not able to invest. But we're not wanting to keep all our money over in the business, because then, our personal side is certainly going to suffer. We're going to see higher debt and whatnot. So we need to find a balance between the two. Now, when we were talking about the S corp, one thing that we have to figure out is sort of what a salary is for that S corp owner, because as the S corp owner, you can take owner's draw, and ideally, if like we didn't have to do any salary whatsoever, we take it all as owner's draw and never fund Social Security and Medicare. But the IRS won't let you do that. Instead, they say you need to pay yourself what's reasonable, and what's reasonable is going to be very different depending on where you live, how much experience you have, all those sorts of things. So one, this is kind of a conversation between you and your tax professional that you work with, because you need to determine what's reasonable for you in your area. And hopefully that what I will say is typically I see what's reasonable is around 80,000, 75 to 80,000. So let's say you're making 150 in revenues, and your salary is 75,000, and after expenses and whatnot, you have about $20,000. You can take that $20,000 as owner's draw. The salary, the 75,000, you'd be paying 15.3% taxes on, and the owner's draw you would not. So that's one way to think about it. Your industry average is going to differ depending on where you live, though. So you need to be very careful about that. How can you do this effectively? And so you're safe, you're paying yourself regularly, and you're accounting for taxes. Once you've reached the S corp status, using a payroll system can really help a lot. One, the IRS is going to expect to see a flow of cash and payment, and so a payroll system does that. And so it almost becomes a necessity when you're at the S Corp level. But even before you're at the S Corp level, you can use a payroll system. You don't have to have an S Corp to do so. It's just, but in doing so, that way you can actually have your taxes removed as you're paying yourself, so it doesn't become this quarterly thing where you become very nervous about how much do you owe, and you've accounted for it through the payroll system. So that can be really valuable, especially if you're having trouble balancing that estimated tax with paying yourself, because that could be a bit of a balance. Make sure as you begin this process, do it the same day, same time. So if you pay yourself every 2 weeks, it's every 2 weeks, that Thursday or Friday, every 2 weeks, same time. And then you just have to decide, do you want it every 2 weeks, once a month, every week? It's really up to you. You just want to be very consistent with it. And then don't alter it is too much. When your income increases and you've got your emergency fund in place and you've got your expenses covered and all that, you can start increasing the owner's draw or the amount that you're paying yourself. So that will come. You just want to get the other things in place before you do. And then that way you're feeling very secure, even in times where maybe business is a little bit slower. Once you understand what your emergency fund is, what your income is going to be, your salary, then do not increase your income until you've reached that emergency fund. So once the emergency fund is in place, then we can start building up a little bit more like raises within the practice, but we want that emergency fund in place before we begin to do so. And I've talked about this a little bit, but essentially what the 15.3% is, when you work for an employer, you're paying Social Security and Medicare tax, but so is the employer for you. And so in total, between what you're paying as the employee and they're paying as the employer, it's 15.3%, except you're each paying half. When you're self-employed, you have to pay the whole thing. And this is why the S Corp versus LLC matters, because the S Corp can help you reduce some of that exposure. The LLC cannot. But again, you have to have income that is above that certain level that ensures that you're paying yourself a reasonable rate, and then also accounting for expenses and all that. So there's enough left over for an owner's draw to make it worthwhile. And until you've reached that mark, then it's not really worthwhile because you're not getting a lot of benefit from it. But then once you reach that mark, it becomes hugely beneficial. So it's an important sort of thing to consider, that S Corp versus LLC dynamic. And as your business grows, it's something you're going to really want to put into practice. With that, within the show notes, I wanted to say there is a tool so you can track your rates and figure out what is a proper rate for you based on how much you want to make in a year. And by doing so, you can get a figure of like what you plan to make in a year, and then incorporate what that means for both your business expenses, taxes, as well as what you're paying yourself, and therefore covering those personal expenses. So make sure to check that out. Hopefully that will help in sort of pinpointing, one, the rate, but also the expectations on the pay. Make sure that you join that newsletter, thinkinghacfinancial.com/newsletter. And then if this has been helpful at all, please send a testimonial and let me know how it's helped you, and let others know, because it'll help share the word, one, of the course, but also the community at large. And that's really what we're trying to grow here. So I'll speak to you soon. Let's go.